Good afternoon, folks. This is Don Graves, and welcome to today's Wednesday webinar. Silver Divorce, Managing the Marital Asset After Age 62. My assistant and I, as we were working on this, she said, Don, I feel a little sad about the topic. I said, well, I feel a little sad too because it's not a happy topic. But as we walk through, it has certainly become inevitable, and we want to show you some ways and some strategies that you can help your clients turn this into something that's maybe not quite as abysmal. I'm Don Graves. I'm a retirement income certified professional and adjunct professor at the American College. I'm the president of the HECM Institute for Housing Wealth Studies. I serve as a business development consultant also with Retirement Funding Solutions, and I'm now in my 18th year as a home equity retirement specialist. In that time, I've had around 12,500 consumer-facing conversations that led to about 3,000 people becoming clients. Since my move into education, we have about 16,000 advisors in the RICP curriculum at the American College. I've had a lot of opportunity to share. And today we're talking about divorce, and divorce particularly amongst baby boomers. The Pew Charitable Trust just released a study, and I don't have some of that data, but it confirms some of the earlier data that says the divorce rate on your screen from 1990 to 2010, generally overall in the population, went on the decrease, except for those over the age of 50. That has doubled. And for those aged 65 and older, the divorce rate has tripled. And so we're looking at something that's more than a statistical anomaly. It is something that seems to be part and parcel with the way the world is going. We'll look at why this is happening and what are some options we have for our clients. But all of this has to do with understanding retirement. For most of us on the call, we're focused on retirement income, which very much looks like this mountain. Here's a picture of Mount Everest. And retirement metaphor really looks at scaling the mountain or climbing the mountain to the time of retirement as the accumulation phase focused on asset allocation, a strategy used to diversify our wealth and holdings to balance our risk to get us to the top, whereas that fellow who just showed up plants his flag and says, I've made it, I hit my number, it's time to retire. But unfortunately, for many folk, once they get to the top of the mountain and ready to retire, they only realize they've reached base camp and the mountain's a little bit higher than what they thought. So they've got to go up a little bit higher, plant another flag, and prepare to come down in the distribution phase or the income allocation phase, which is how do we diversify our income and what are the strategies that we need to have and maintain purchasing power for a 20, 30, even a 40-year retirement. Well, it's on the downside, on the descent, where the danger comes. 2/3 of the people who died on Everest died after they reached the summit. The American College has compiled what they consider the 18 major risks in retirement. We won't go through all of them, but it's important to understand that these come on the descent, on the decumulation phase: longevity, inflation, excessive withdrawal risk, market risk, sequence risk. There's another study that has 25 risks. Some have 30. But the point is, these are all exacerbated on the way down. I helped write a little handbook for advisors. You can get a download of that at 18risks.com. It's a 9-page handbook. Outlines all of these, and it also specifies and looks at how housing wealth can accomplish and mitigate some of those risks. The 4 most common goals that retirees have are the 4 L's: longevity, lifestyle, liquidity, and legacy. Longevity goal is the client says, well, I have enough money to meet my basic living needs. This will become highlighted as we talk about divorce. Lifestyle, will I have enough money to maintain my standard of living? Liquidity, will I have access to money when I need it? And legacy, will I leave a lasting financial impact, or how will I financially be remembered? All of this is being driven by this group on the screen right now, the baby boomers. You know them on the screen. If I was live, I would say, what's the name of this group? And someone on the call would yell out, the Rolling Stones. And I would say, no, the strolling bones, because these guys have gotten pretty old in our lifetime. The baby boomers, you know this, born between 1946 and 1964. 10,000 a day turned 62, but that's not really the big number. The big number is 10,000 a day turned 70 and a half. The largest withdrawal of accumulated assets is beginning now. Trillions of dollars that are held in IRAs and others are now facing minimum requirement distribution. That's a big thing. They're going to live longer. They haven't saved enough. Up to 68% of them are carrying some sort of mortgage debt, second mortgage, home equity loan into retirement. But look, folks, here's the great news. This last piece, 87% of baby boomers own a home. And that's the group we're focused on. That's what we're going to talk about, because that's where this idea of silver divorce is really taking root. The typical retirement planning picture that everyone works with on the call is your client has income, maybe a pension, Social Security. They've got investments, 401k, 403b, and they have insurances, life insurance, annuities, variable insurance, a business to sell, a second home, something they can fall back on. And out of that, you've got to manage the distribution phase through systematic withdrawals, a certain percentage adjusted for inflation, a bucket strategy, or flooring strategy, where you convert a certain amount to predictable monthly income. I love Tom Hegna, Paychecks and Playchecks, Curtis Cloak, Divide and Conquer, and other similar strategies. Dr. Wade Fowle says there are 39 other hybrid strategies, but it's always the same 3 buckets to work with. The question is that really enough? An article from CNBC said this last year: cash-strapped boomer, you can retire using home equity. I love the quote. It says retirees, and I think we can substitute advisors, simply cannot afford to ignore home equity as an income source and still meet their clients' retirement goals. The U.S. Census Bureau looked at this for the average retiring married couple at age 65. They reaffirmed this in 2008 that says that as a part of the total wealth, the average person has less than $100,000 saved, but close to $200,000 in home equity, meaning that the largest part of a person's wealth is their housing wealth, encompassing 68%. How do you use and strategically implement housing wealth into the conversation? A wonderful slide here, the 2 big numbers on the bottom. 87% of boomers own a home, up to 68% may be carrying some sort of mortgage debt into retirement. So is this planning enough? Is this model that you see on the screen sufficient to help our clients mitigate the risk, meet their 4 most pressing goals, and maintain their spending power throughout their lifetime, which could be a very long retirement? I submit to you that it may not be enough, and we're going to talk about housing wealth. Housing wealth. What does it mean to add housing wealth to the equation? Now, most people know what this is on the screen here, this image. It's a computer mouse. That technology, I'm using it right now. See, I'm going to move. You see that? That's my computer mouse moving it. Developed by Douglas Engelbart at the Stanford Research Lab in 1964. For the first time, you didn't have to use key cards or keystrokes to do something on the computer. He developed this little box with a red button on top, of a little square block and red button, and if he moved it, it moved something on the screen. And he took it to IBM and Hewlett-Packard, and they said, what's the purpose of that? Do you think it's going to do something? No one bought it. Eventually, Xerox at the Palo Alto Research Center bought it because they bought everything. And they tried to figure out what to do with it. Eventually, they put it in their everything room. You have that in your house. It's a drawer in your kitchen. You've got Legos and keys from 3 cars ago. The everything drawer, Xerox had one. And they put it in there. And in 1974, a young entrepreneur preparing to have his IPO startup negotiated with Xerox to see what was in their everything room. And they let Steve Jobs come in and see. And as they were demonstrating various technology, they demonstrated this. And the New Yorker magazine some years later wrote Steve Jobs' story and said that Steve Jobs jumped up and down, twirled around, hyperventilated, left the room, came back and says, do it again. And they did it. And they looked at him perplexed. He said, this is the future, right? You're going to do something with it, right? You're using this. They said, what do you see? Well, we don't know. We can't figure out what to do with it. He says, you're kidding. Twirls around, hyperventilates, leaves the room. calls his partner and says, I found something that will change everything. Steve Jobs, 10 years later, releases it in the Apple Mac, and now this technology is part of our tablets, our cell phones, our computers, our laptops. And Jobs went on to say if Xerox had known what it had and taken advantage of its real opportunities, it would have been as big as IBM and Xerox combined, the largest high technology company in the world. See, it's possible to see something and not really use or know what it's useful for. So today I'm hoping that in this particular case study, you may see something different that you've never seen before. Helen Keller, American author, was asked, is there anything worse than being blind? And she said, yes, having sight but no vision. So I hope you see something today, but more than seeing something, I hope you catch a vision. So how do reverse mortgages and retirement savings work together to enhance retirement outcomes and client satisfaction? Particularly, the case study today will, how does it help with silver divorce? Let me do a quick rewind a few slides. What is a reverse mortgage? For those who may be new on the call, you don't know, you can go to HECMwebinars.com. I have a whole series of this, and there's education there that I teach at the college. You can have access to some of that. But a reverse mortgage, I used to say, is a good way to ruin a barbecue. I mean, you get 10 people. I was in North Carolina, and they like that pulled pork down in North Carolina. I'm from Kentucky. We didn't like pulled pork. If the pork's not on the bone, I didn't want to eat it. But you get a good barbecue down there and get 10 people around the table with the pulled pork and potato salad and just say, hey, I'm thinking about recommending a reverse mortgage for Mom, and watch what happens. I mean, it used to be a full melee would break out. But 4 words I think will help you. 4 words will stop you from getting in a fist fight with family members over the barbecue when it comes to reverse mortgage. What are those 4 words? It's just a mortgage. A reverse mortgage, folks, it's just a mortgage. I was in Detroit a few years ago, last year actually, and I wanted to go to Dearborn and see Ford. I'd never been there, the Ford plant, and there was a poster, and it had all the cars Ford had made since the Model T. And one thing I noticed is all those cars had 4 wheels, an engine, a steering mechanism, and a braking mechanism. They were all essentially automobiles. Other than that, they were very different. And a reverse mortgage is just the same. It's just a mortgage. I don't have time to unpack that, but the home equity conversion mortgage is the official name and the name that I would encourage you to use, a home equity conversion mortgage. Developed 30 years ago for those age 62 years over. Only one of the spouses has to be age 62, by the way. Allows them to use their home converted to tax-free dollars to be used in a prudent way. You don't have to make monthly payments. You don't give up ownership or come off title to the home. You're not going to repay more than the home is worth, even if the home depreciates in value. If you want to know more about that, just go to HECM Basics, HECMBasics.com, and you can see some videos and some other things. But remember, it's just a mortgage. Well, how much money can my client get? This will come up later. The amount of money your client gets is based off of 3 things, so 3 building blocks: the age of the youngest borrower, the value of the property, and the interest rate associated with the program. It must be a first mortgage, so any existing mortgages, home equity loans, judgments, and or decrees, including divorce, have to be paid off from the proceeds of a reverse mortgage. And I want you to think 50%, 50% up to the lending limit. So if your client has a $200,000 home, a reverse mortgage makes around $100,000. A $400,000 home, it makes around $200,000. Don, if my client has an $800,000 home, how much will a reverse mortgage make available? 50% of the lending limit, which is $636,150. So it makes around $318,000 available for a 65-year-old. That's the maximum. So please keep that in mind. The spending options, you can have done in a lump sum. I can't give it to you all in 1 year, but I can back the dump truck up 60% the first year and 40% the second. A line of credit, a monthly 10-year payment, which means I'll send you a check for as long as you have the loan and living in the house. A monthly term payment, don't only need the money for X amount of times, or a combination. And finally, how does repayment work? The reverse mortgage gets repaid when the last surviving borrower permanently departs the home, moves, or diseases. At that time, whatever money was advanced to them, think of a Visa credit card. Think of a Visa credit card. If you've got a $100,000 credit limit and you don't use anything, you don't owe anything. But if you used up $50,000, you're going to owe $50,000 plus accrued interest. And 100% of the remaining equity is passed on to the borrower in case they move their heirs or their estate. That's the HECM. Again, you can go to HECMBasics.com or It's Just a Mortgage. It's justamortgage.com, and you can find that. So let's talk about divorce and the baby boomers. I looked at that picture. Every time I look at that picture, chills go down my spine. I'm going to open up the question box here, but I asked my assistant, I said, what do you think she's saying or thinking while she's looking at her husband? I'm curious. In the question box, if you've got an answer to that, and there's a few questions over here. Let me go over here. Some of the audio has been going in and out. I'm sorry about that, and I hope it's better now. But if not, I will call Comcast when this is over. But I looked at her and I thought, now what is she saying to him? And what is he saying or thinking? And I came up with, well, I won't say it because this is recorded, but he has to look, what did I do? I just don't understand what I did. And she said, you're such a, well, divorce is difficult. And that's a steely look. Anybody's been married more than 10 years, you know that look, both husband and wife. That dumbfounded look of husband. Well, silver divorce. Let's talk about this and what are some of the common reasons people are divorcing? Baby boomers. Well, there are unprecedented levels of divorce for boomers during their young adulthood, meaning they got divorced earlier. So here's one of the studies that came out, a few reasons that second, third, and fourth marriages, or second and third, are at a higher rate of divorce. Look at that, 50, 67, 73%. Number two, more women are financially independent. They no longer need a man to support them in a lot of ways. Number three, down at the bottom, the attitudes towards divorce are shifting. 69% of Americans think divorce is morally acceptable compared to 48% in 2001. And empty nests sometimes lead to empty marriages. There's a danger zone in that. And the last one is that we're living longer, and retirees may have decades ahead of them, and they don't want to be unhappy, one survey said. So these are some of the common reasons. 1 out of every 3 boomers today is unmarried, Gray divorce or silver divorce seems to diminish their wealth more than early divorce because there's less time to recoup. And so the unmarried boomer, 19% of them are living below the poverty line. 2 out of 3 gray divorces or silver divorces are initiated by women. That's the look she was giving to him. And the challenge is few women, when they do that, there's some challenges to spousal support for Social Security. And there's some rules and guidelines along with that. There's a funny story that Johnny Carson, some of you remember him, had 3 wives, and each of his wives were married to him at least 10 years, and none of them remarried, and all of them were getting his Social Security. Who's getting married and who's not? 4.5 million people aged 50 or over are cohabitating. That's a 75% increase from 2007. 50% of those people who are cohabitating are divorced. A fun statistic, the knitting queen, 1958, the 50-plus dating scene. Match.com says the fastest growing demographic are the boomers. So here's the reality of gray divorce. Divorcing in later years presents some particular challenges. There are 10 of them listed on the screen. Retirement dollars, Social Security, income, spousal support, division of assets, insurance, adult children, long-term care, competency, and estate planning. But by far the biggest of those is the housing asset. The marital asset is by far the biggest. So how do we look at this situation? Let's meet Mark and Linda. They're retired. They're 65 years of age. They've been married a long time. $405,000 in savings, and they're beginning to take out first-year draw, and they've got a $400,000 home. And upon meeting with them, you discovered Linda's primary concern was she wanted to have enough money for all of her retirement. She didn't run out of savings. Longevity, Mark wanted to play more golf. He had a lifestyle concern, but things went sideways for Mark and Linda, and they filed for divorce. And the divorce said the marital asset plus the other assets had to be divided. So what are they to do? What are they to do? So Mark and Linda had $405,000 in shared savings and a $400,000 home. So choices with this housing asset. Here's the first choice. One spouse chooses to stay in the home and buys out the other spouse. Now, the house is $400,000. They need to come up with $200,000. So in order to do that, the one spouse who stays at the home either has to take out a mortgage, give it to the other spouse, and begin making payments, or they've got to pull the money out of savings. Those are your two particular choices. Choice number two, one spouse, you could sell the home, and each one takes their proceeds and starts over. So let's just say the house sells and each person gets $200,000. Well, you can go buy a smaller home. You're in a $400,000 home, but you say, hey, he's not here, she's not here, I need a smaller home. You can buy a smaller home. You can rent. Save the money, just start paying rent. You can save for it. That's not a house big enough. Don, I'm going to buy a $300,000 home and take out a mortgage for the difference, or I'll just pull some money out of savings. Those are the choices for that. Now, I want to give you a few more choices here and see if we can turn silver divorce and see if it has some sort of silver lining to it. So here's a choice you can make. One, you can choose the home equity conversion mortgage or the reverse mortgage. Use those proceeds to buy out the other. So remember, we've got a $400,000 home, a 65-year-old. It's going to make around 50% available. So one of them says, I'm going to stay. They do a reverse mortgage, and that divorce decree becomes a judgment, and they use the $200,000 to pay off the other spouse. What's the benefit? The benefit is they get to remain in their home. They have no monthly mortgage payments, and they're not pulling out any money out of savings. Not a bad deal for the one who wants to stay there, keep their savings intact, keep their cash flow intact, and use the HECM to do that. Now, here's some other choices. The HECM for purchase. Now, the HECM for purchase started in 2009, part of the Homeowners Economic and Recovery Act signed by both houses of Congress and the President, that allows you to purchase a home using the home equity conversion mortgage or reverse mortgage to purchase it, paying about 50% down and having no monthly mortgage payment. So let's look how this works. So you've just given your spouse $200,000. So we're going to see the divorce proceeds are $200,000. And the spouse would like to buy a $300,000 home, but they're going to use the HECM for purchase. So the HECM for purchase, as you recall, makes around 50% available, a little more, $154,000. So that's the permanent financing. That means the client has to bring $146,000 down to move into a $300,000 house. That's what they do. And they've got $54,000 left over. What's the benefit? They have no monthly mortgage payments. They didn't have to draw from their savings. They've got $54,000 left over. And yes, they've moved into a $300,000 home. That's closer to the $400,000 or the lifestyle that they were used to. That's what you're able to do with the HECM for purchase. But let's say the client decides, you know what, I want to move into a bigger house. I want to have the lifestyle I had before. Fine. So you'll see here on the screen, they want to move into a $400,000 home. How much is that going to make available to them from the HECM for purchase? That's right, around 50%, a little bit more. Now the client has to add $192,000. So for $192,000 down, they can move into a $400,000 home. That leaves them with $8,000 left over. The benefit, no mortgage payments, no draw from savings, and $8,000 left over, and they moved into a $400,000 home. Now wait a minute. Now your client, the husband or wife, maybe they remarried. Maybe they want a bigger lifestyle. And they said, you know what? I'd like to move into a $500,000 home. Something more than what I was used to. Well, they can do a HECM for purchase on that. Around 50% down. Now your client has to add $246,000. Well, they have $200,000, which means they're going to bring $46,000 from savings. The benefits, they have a new home and a fresh start. They have no mortgage payments, and they had a minimal draw from their savings. So you see, in all three of these cases, moving to a $300,000 home, $400,000 home, or even a $500,000 home, when we're looking at silver divorce, the HECM gives them options that they didn't have otherwise. Now, what if your client just said, you know what, I'm just going to buy a simple townhome for $200,000 and just a little condo, that's all I want. Well, the same scenario. Now they only use $96,000 to move into a $200,000 home. They've got $100,000 left over. They've been able to take, remember, they divided half of their savings. They had $400,000 in savings, so he got 200 and or she got 200. But now we've added $100,000 back into that. They haven't been made whole, but they're a lot better off than where they were before. Do you see the silver lining in this? The silver lining is using the HECM for purchase allows the client, one person can stay and give money to the other, and they can do this, or both of them. They say, you know what, I don't want the house either. Either of them can take their $200,000 and do any of the things that we talked about here. Buy a house at $200,000, $300,000, $400,000, $500,000. We have some real estate professionals on the line right here listening to the call. As a real estate professional, that meant one meeting produced for you three good options. You listed the house that they were leaving, the marital property, you listed that, and you sold them two other houses. So you got three transactions that provided a silver lining for this couple out of one meeting. Let me show you one final thing. Because Pierce and Linda are both young, maybe they're still working. And one of the things I talk about often every week is the power of making a payment with a reverse mortgage. I just want to show you a quick snapshot because Linda may say, Don, you know what? I'm still working, and I heard you can make a payment on a reverse mortgage. I just don't know why I would do that. And I say, well, Linda, let's take a look at it. Let's say you bought the $300,000 house. You've got $54,000 left over, no mortgage payment, but you decide you want to make a payment. Why would you do that? So let me give you a scenario here. So the principal limit Linda has is $162,000, and the outstanding balance is $162,000. That's the money we made available plus any finance closing cost. So principal limit is part of the reverse mortgage. It's always going to be growing. I'm going to show it growing at 5%. The outstanding balance is growing because that's going to get paid down the road unless you decide to make a payment. If you make a payment, just like in a regular mortgage, your loan balance goes down. Now, here's the wonderful thing about the reverse mortgage is there's a built-in line of credit. Linda doesn't have a line of credit. Right here, it's zero. So let me show you what happens if she makes a payment. So the first year she has a reverse mortgage, her principal limit goes up because it goes up every year. Her outstanding balance, because she made a payment of $1,200 a month, she's still an executive of some sort. Look what happened. Her balance went down. So the principal limit minus the outstanding balance equals a line of credit. The line of credit is growing today at about 6%. I don't cover that today, but if you, the reverse mortgage line of credit is called a RELOC, R-E-L-O-C. If you'd like to see this example, you can go to reloc.net, R-E-L-O-C.net, and you can see I've written about that, and there's a longer explanation. So let's go at years number 2, years number 3, year number 7, and year number 11. Let's just go out here. So Linda has decided she worked, she enjoyed working, she made a payment. So now she says, Don, it's 11 years down the road I've made a payment. So what I owe the reverse mortgage is less. I said, that's right. But notice what happens. She's got a line of credit that's now $207,000. That $207,000 is growing at approximately 6% today. The example at reloc.net shows it at 5%. So Linda, if she stopped making payments right there, that line of credit will continue to grow. It's accessible to her. It's bidirectional, which means she can take money out. If she's got required minimum distributions, she can put money back. She can do whatever she wants with it. And though she probably won't pay this for 20 years, if she did, this next slide shows what happens if she says, Don, I'm just going to keep paying this like a mortgage because I've got some resources. I said, Linda, that could be very smart. By the way, if you're on the call and you're listening and you've got a client and you're sitting with them on your annual review or initial meeting, and you notice that they have a mortgage payment, here's a question that's finding great success with people. You can ask them, Bob, Linda, what would retirement be like if you didn't have to make a monthly mortgage payment? Now, they're going to answer that one of two ways. They're going to say, it would be great. We could do X, Y, and Z. When they say that, that lets you know that you have an opportunity to often free up a monthly mortgage payment by doing a HECM replacement, which is replacing their traditional amortizing loan with the HECM, and that frees up cash flow. That cash flow, be it $800, $1,200, $1,700 a month, can be used to reduce the draw on their portfolio, increase their lifestyle, provide gifts to children or grandchildren, all sorts of things just by eliminating a mortgage. The second thing you'll hear when you say, Bob, Linda, what would life be like if you didn't have to make a monthly mortgage payment? They would say, you know what, we're comfortable making it. You say, great, great. What if there was a way I could show you that you continue to make your payment, have a tax deduction, reduce your balance, but also create a $500,000 in a reserve fund that you can use at any time in the future as long as you're living in this home? They're going to look at you and say, what are you talking about? And you describe to them what I've just shown you here. This is a regular reverse mortgage that you have a client that has a mortgage. You get them to swap it out and then make a payment. And then down the road here, 13, 17, 20 years down the road, you've created a reserve fund that they can access. Well, that's something that Linda did, or Pierce, or husband, could have done if they decided after divorce, I'm going to make a payment that down the road, 13, 17, 20 years, not only will I have the money that I've got a new housing situation, I've also got a reserve fund for spending shocks. Well, folks, that's really the ways that you can turn a silver divorce into a silver lining. What are some ways to implement this strategy? Here's what I suggest on every client meeting: talk about housing wealth as a part of a comprehensive financial plan. Cash flow creation, portfolio preservation, having a backup plan for risk and volatility, having a hedge for spending shocks. Talk about housing wealth as part of a comprehensive financial plan because it is most of your clients' biggest asset. If not, it's a significant part of that. When it comes to divorce or these type of situations, you must talk about it because you're giving your clients some tremendous options. I suggest providing collateral education materials to your clients. Education, not sales material. A few education materials. There's a Forbes article, came out last year. Wonderful. 5 ways a reverse mortgage can help your client's retirement. It's really fantastic. The American College had an article called Making a Case for Reverse Mortgages and Retirement Income Conversations. That's Dr. Robert C. Merton on the cover. Won the Nobel Prize in Economics. That's me on page number 2. Here's a handout on the HECM for purchase. The slides I just showed you shows going from a regular house to a bigger house. It showed a house, so that's an upsize, and this is a size or a downsize. It's a little sheet, a cheat sheet that you can get from the person who invited you to this call. I recommend you have it and that you're able to show your clients the power of moving to their last and final house. Whether it's a divorce or not, you can use this and put more money back into their retirement. And finally, for the person who invited you, there's a buyer's guide. This was developed by my sponsor, Retirement Funding Solutions. And I want to tell you, this booklet is phenomenal. It's absolutely phenomenal. So it's a buyer's guide. The person who invited you, ask them to send you a digital copy. And if you're really nice to them, they may put one in the mail to you. But it's something you want to have because it talks about the HECM for purchase strategy, which we talked about a little bit here. But you want to have some collateral education material. And make sure you keep your HECM partner on speed dial, the person who invited you, that when you're sitting in front of a client, you're able to say, listen, let me call Bobby, Ron, Billy, Teddy, Ronnie, Bobby, Ricky, and Mike. I think that was a new addition. And finally, consider hosting an education workshop or webinar on reverse mortgages. I'm doing an interview tomorrow, the Lead Generation Summit. And I'm being interviewed, and really some powerful folk. I don't know how I got on this, but my title is called How to Develop Massive Untapped Boomer Leads Through Reverse Mortgages. That's my um, title. So hope you listen in on that. I want to pause now and take a few questions here. If you've got some questions, I'm going to open up the question box. Thank you, Samantha, Ronnie, Bobby, Ricky, and Mike. She got that, Samantha Wilson in sunny Florida. Let me take a few questions. If you need me to go back and review any slides or go back and repeat something, I'm glad to do that. So while you're typing your questions, it takes about 60 to 90 seconds to get to me. Let's read some of the early comments. Greg says, how am I doing? I'm doing okay, Greg. Go Seahawks. I tried to delete Sandy. Sandy, yes, we love Russell Wilson. Greg Eastman, oh my gosh. I hope he's not related to Steve Eastman, because then that would be the Patriots nonsense. And I won't talk about Belichick and Deflategate, but we all know last year for the Super Bowl, he broke into the hotel, set off the alarm, caused the sprinklers to go off, and that other team was out till 4 in the morning, and we've got video of Belichick in a hoodie doing that. So we know that. We know that. All right. Questions. Doug asks, since there are no required payments, how important is credit as far as qualification is concerned? Great question, Doug. A reverse mortgage, the three criteria that we make dollars available based off the age of the youngest borrower, the value of the home, and the current interest rate. Now, since the last 2 years, there's been something called financial assessment. We look at two things. Does the client have residual income? Do they have enough money at the end of the month to make a to meet their basic housing needs, taxes, insurance, maintenance? We don't normally have a problem with that. The second is, have they been good credit citizens, particularly when it comes to paying their taxes and homeowners insurance on time? Those are the big stickies for HUD. So we look at that. It doesn't disqualify them from a reverse mortgage. But if it's severe enough, they may require the reverse mortgage to pay their taxes and insurances for them over a certain time period. Great question, Doug. Appreciate it. Samantha, up Sandy. Does HECM for purchase work for manufactured housing in senior parks? It can, Sandy. Manufactured housing, the old name was mobile housing. It was some people say, is it mobile modular? I said, no, modular is like Legos. It came in pieces and they stacked it and put together. Manufactured is on wheels. It has a truss underneath the house. And normally you get a title with that and not a deed. HUD will do that depending on when it was built, depending on if you own the land, depending on if they can find other comparables. So it can be done. And Samantha, can you go back to the reasons for silver divorce slide? Sure, Samantha, I'll go back to that. Let's find that. And I'll put that up for you. There you go. Great. And take a screenshot of that, Samantha, or email me. Okay, Sandy, New York Times article, seniors seek to protect reverse mortgage policy to ensure surviving spouse not kicked out when home primary due. Sandy, the surviving spouse cannot be kicked out now. That article came because there was some language that says they were thinking about changing some language. Right now, if you're 74 and your wife is 54, yes, it happens because of ginkgo biloba. I've got some. You can get a reverse mortgage. It's going to be based off your wife's age, 54, and there's some spousal protection. It means that if you predecease her, she doesn't have to move out of the house if she's the rightful heir, which means you've got a will or trust that says, yeah, my wife can stay here. So that's a protection now. There was some thought about changing the language. Two senators got their britches all in a bunch and said, hey, let's clear this up. And so that hasn't changed. Another question, most senior parks are on rented land, but on the house. HUD will do rented land, Sandy, if the owner gives a 99-year leasehold, 99-year leasehold, which means, yes, it's rented land, but we're willing to create this document. Some of them already have it in place. That creates a 99-year leasehold. So that's certainly a possibility. Certainly a possibility there. All right, we'll take a few more questions, and then we'll wrap this up. And we'll see here. Doug says, is the line of credit safe from Medicare? Great question, Doug. And there's Medicare and there's Medicaid. Medicare comes when you turn 65. It's a medical portion of Social Security, and that is protected. There's no home equity loan or line of credit that infringes upon that. Medicaid is a means-tested program. Food stamps or Medicaid, if you go on nursing home or get some sort of home care, that often comes under Medicaid. Medicaid has a means-tested program. If you take all the money out from your line of credit, put it in your bank account, and you've got $500,000 in your bank account, Medicaid is going to ask some questions. And so what we have been telling clients for 2 decades is don't take the money out of the line of credit. Take the money and spend it in the month that you use it, and there'll never be an issue with that. Great question. And Sandy reemphasizes that reverse mortgage is still a loan. That's correct, and not income. Super. Great. Samantha says, are there types of housing not covered under HECM? Tiny houses. Do you have a tiny house, Samantha? You and Jude moved to a tiny house? I don't. Any house that's fee simple, owner occupied, is eligible. There's no square footage restriction on the HECM. So a tiny house or the big jumbo house is available for the HECM. I'm too big for a tiny house, folks. I wouldn't know what to do. And so let's have a big giant yard, and I'm just too big for that. Well, listen, gray divorce is on the rise. It's inevitable in your practice. In your practice, you're going to meet someone, some couple, or hear about someone who is divorcing. 87% of those who you will hear about who are divorcing will have a house. What you're going to be able to say to them, their elder law attorney, their divorce attorney, their estate planning attorney, is that if they have a house, the HECM provides them some alternative solutions and options that they may not have considered. Make sure you get the collateral material. Make sure you listen to this over again. It wasn't a long one. Now next week Wednesday, oh man, you want to be back for next week, because we're going to talk about why up to 68% of boomers that you sit across from have a monthly mortgage payment, and 10 things that can happen that supersize their retirement if they can get rid of that mandatory monthly payment. 10 supersized retirement things. So you want to be there. If you are on my email list, look forward. You can go to HECM webinars and sign up there. If the person who invited you, you can go to RFS webinars. But just make sure you get there. Hey, let me mention something that's coming in the fall. I've been working on for a few years out at the American College Filming, the HECM Institute. We've got the HECM certification program, 5-hour course where you can take these principles, learn them, not only learn them, but you learn the questions, scenarios, statements, and stories that will help you not only get in front of more clients, but convert more dollars, keep more assets under management, and brand yourself to really be the expert in this area. Nearly 70% of baby boomers do not have a financial advisor or a workable written retirement income plan. It's a large, untapped market. But guess what? 100% of baby boomers have already seen, read, or heard something about reverse mortgages and are favorably disposed to them. Do you know how to get in front of those people? And when you do you know what to say? Well, stay tuned in the weeks upcoming that I'll be telling you about the certification program. I promise you, you're going to want to be a part of that. Anyway, email me if you have further questions, or the person who told you. This is Don Graves. We'll talk to you hopefully next week. Bye now.